What's better, $1 million in an IRA or $850,000 in a brokerage account, a taxable account? It's going to be fun to see. We're going to go over this right now. So let's dive into this. We're going to use old Tim and Kim's sample here. All right, this can be as simple as possible we can be. We're going to go up to profile. We're going to go to net worth, and you got $850,000 in, I guess Tim didn't have 403B. So we got $850,000 in Kim's taxable account. All right, so let's get rid of the word IRA. You can see taxable account. So Kim's got $850,000 in VTI in a taxable account. We're going to assume a cost basis of $550. So she has a $300,000 capital gain, unrealized capital gain. We're going to say they have $340,000 in a home. That's it. That's all they got. That's all they got. All right. We're going to say they're both 65 now and they're retired. All right. So they have no income other than, so their salaries, there's no salary coming in because they're retired. Other than Tim's Social Security, it won't be much, $1,884 a month, and Kim's Social Security, $2,745 a month. That's it. All right. That's all they got for income. They got no pensions, nothing. All right. So that's what they have. That is, so if you go up to investments and we go to tax allocation, all their money is in a taxable, in terms of their liquid money, is in a taxable portfolio. All right. So check this out. So what we're going to do is we're going to go to retirement, and we're going to go to cash flows, and we're going to see what's their bill. You always want to double check your cash flows. So they got expenses here, and their expenses are $76,000 a year. Because how did we get those expenses? We click on it. They're living off $5,000 a month. They got $6,000 a year in property tax, and they got $10,000 a year in healthcare. All right, so those are their expenses. $76,000 a year in expenses, all included. Now that does not include taxes. All right, so we go back to cash flows. Cash flows. Taxes is its own line item, and we can see their tax rate here is not much. All right, so that's interesting. Huh? So we got income flows 0, so they have to pull $76,903 from their portfolio in which to live on. Income flows 0, they're gonna have to pull $78,000 from their portfolio in which to live on. The following years they take Social Security, $56,000. All right, is their Social Security. Their expenses go up every year adjusted for inflation, and they're still pulling from their portfolio $24,000, $20,000, $20,000 to offset and augment their Social Security. But what you can see is their taxes are very, very low. All right, they're not hardly paying anything in taxes. So they have $64,000 coming in, they get $84,000 going out, which means they got to pull $20,000 from their portfolio, which they're going to have to pay a little bit of capital gain on, not much, which will be taxable as capital gain rates. So not much in terms of taxes. All right, so look at that. So they're pulling more and more from their portfolio. Hopefully the portfolio is growing more and more and more. All right, until they die at 90. And here they got $105,000 coming in from Social Security. They got $147,000 going out. They got $4,000 of taxes. So that means they have $152 of total outflows, which means they're going to have to pull $46,000 from their Social Security, from their investments. All right, so let's go to analysis, and we're going to say they have a 92% probability of success. That's perfectly fine. They're going to leave $1.4 million of liquid assets to the kids, 1.4. And again, though, that is just the median amount. That dark blue vein right there is the median. 50% of the time they leave more, 50% of the time they leave less. You can see right here, 8% of the time, it doesn't show here, but we know it from the previous screen, they ran out of money. All right. Now, 5% of the time, they had $6.4 million or more. All right, so 8% of the time they had $0. 5% of the time or less, they had over $6.5 million. So that's a pretty wide berth there. But anyway, they're leaving a median amount, $1.41 million, to their kids. All right, so far so good. So now what we're going to do, we're going to go to tax, and we're going to say, ooh, not much. Look at that. I mean, I can't remember where they live in California, I think, but anyway, look at that. I mean, that's just low. That's under 3%. So they're not paying much in taxes, man. And I bet that's not even true. But anyway, they're not paying much in tax. So let's go back to retirement. We're going to see, yep, 92% probability of success. Looks good. And then we're going to go to cash flows, and we're going to see, hit the RC totals here, and they're going to pay $28,000 in total taxes right there. $28,000 in total tax. Let's see how much they leave. If the average investment return, I think, is what, 6% I got? Yeah, 6.5% right here. if they average that each and every year on a linear basis, which they won't, but just it's, it'll show us at least how much they leave if we average 6.5% each year. And we'll go to cash flows, and we'll go to accounts. Yeah, accounts. And oops, let's go to invested assets right here. No, we want to go net worth. So they're going to leave $2.182 million in non-qualified assets. So that's what they're going to leave to their heirs. $2.182 million, which the heirs will not pay tax on because of step up in basis, unless Steely Joe gets his way, which I just don't think he's gonna. So that's pretty good stuff across the board. Lastly, we're going to go to a summary, expenses, healthcare. We're going to hit our thing. They're going to pay $568,000 of healthcare. Okay, so that's what their total cost of healthcare would be. They say, oh my goodness, you need $568,000 to cover your healthcare. Yeah, they also need $202,000 to cover the housing. They also need $2 million to cover their living expense. So that whole thing's nuts. All right, so now let's change this over a little bit. Let's say they got $1 million in investment. We're going to make it an IRA for old Kim here. All right, we're going to save that guy, and we're going to make this a investment. And let's go down to here, and we're going to have $1 million in a divided by 198.29. They got 5043 shares in an IRA. 5043 in an IRA. All right, so they're going to have $1 million now that they're going to have as opposed to what we just saw. So let's go to retirement, and they're going to have a 94% probability of success with a 1.549 million. So they're going to, in this case, the median they're leaving is about 135,000 more for the median. If we go to confidence, 6% of the time they run out of money, and then still about the same, 6.8 million. 5% of the time they have at least 6.8 million. 6% of the time they run out of money. So that's pretty close, man, and not a huge variance there. So that's pretty good. All right. So it's right about the same. All right. So they have a 15% less to start with, and they leave about $135,000 more on the median. So let's go to tax. So let's check this out. Ooh, look at that now. So now their taxes are going up 10%, 10%, 1% to the state of California, 10, 12, 12, 12. Oof, that begins to look pretty ugly, doesn't it? All right, so now let's go back to retirement, cash flows, and we're going to hit taxes. Ooh, they're leaving they're going to pay $387,000 in taxes. Yikes. $387,000 in tax. Ooh, Nelly. And then let's see here, how much they're going to pay in health care. I think it was the same amount as before, actually. We want to go to expenses. Healthcare, 568. So the same amount of healthcare. Okay, gotcha. So that's, now let's go to invested assets. Oops, let me go to accounts. There we go. I thought maybe it was invested assets. Or net worth, that's what it is. So here they're leaving $1.326 million in qualified assets to the kids and $979,000 in non-qualified assets. So here, I don't have my, let's see, we'll say $1 million. They're leaving $2.326 million total, but this right here will be taxed as ordinary income to the heirs. So actually, when all is said and done, they're actually leaving less to the heirs from a pure tax perspective, from an after-tax perspective. So not only do they pay $350,000 more in taxes over their life expectancy, even though they leave a little bit more, about $150,000 more to the heirs, net of taxes, they're actually leaving less, if that makes sense. Look at that. That's crazy, right? That's nuts. All right, so now let's do this. Let's kill off old who we got, Tim and Kim. So let's kill off Tim first. We got him down at 90, her down at 90. Let's kill him off at 85, and let's watch the difference here. So we're going to kill him off at 85. All right, now let's look at tax. And you should see a jump. Yeah, look at that. There's the widow's tax trap right there. Interesting, huh? So now let's go to retirement cash flows. So old Tim is done at 85. 93% probability of success. They're leaving 1.512 million. All right. And we're going to go to confidence here. That's the median again. Let's go to confidence. 6.7 million on the high end. All right, gotcha. So that was about the same. Let's go to cash flows. And we're going to hit right here. and they'll leave $413,000 in tax. All right, $413,000 in tax. Let's go to expenses. Healthcare will be 503 in healthcare, 503 in HC, and then we're going to go to net worth, and they're leaving 1.326 million, and then 921 tax free. Okay, good. So you can see here, all right, 2.805. Interesting. All right, so now let's go to change this. We're going to go to profile, and we're going to go to investment, and we're going to make that 850. All right, blink. All right, so we got 850,000 divided by 198.29, 4286. 4286. Save that guy. Change this to a taxable account. Save that guy. All right, so they're leaving 15% less. Okay, gotcha. So now let's go to retirement, and let's see what we got, shall we? 92% still, 1.3, same, almost the same thing, 1.37 million. So basically still 150,000, about 150,000 less. All right, we go to confidence. 6 point, yeah, pretty close in terms of the confidence ratios of the various standard deviations, whatnot. So that was pretty good. All right, so let's go to tax. Let's see what this looks like, shall we? Right there. Interesting. So they got the widow's tax trap right there. We have to find out what's going on there. So basically, no tax until old, I keep wanting to say Doug, but it's Tim dies. So let's take a look now. We're going to go to cash flows, and we're going to go to right here. They pay 81,000 in taxes. All right, 81 versus 413. Again, about 81 versus 413. So $300,000, 250 less in taxes here. Isn't that crazy? Let's go to net worth. Here they're leaving 2.12 million in a tax-free account to the kids. So again, they were leaving 2.1. Let's see, they were leaving before 1326 plus 921. Oops, 921. They were leaving 2.247 to the kids, and now they're leaving 2.12. But the 2.12 they're leaving now is completely tax-free to the children under the current tax law. Whereas here they're leaving a whole lot less because of net of taxes. Interesting, huh? That's cool. All right, so now let's go to expenses again, and let's take a look at healthcare expenses. Healthcare is they're going to save about $30,000 less on healthcare, and the reason for that is because there's no in the previous account they're going to be paying IRMA taxes. So let's take a look at the 1040. What's the deal with the what's the deal? Why are they paying? Oh, I want to go to cash flow. So when he dies, their taxes go here. Why? So let's take a look at tax payments. Federal tax there. So that would be in year 2042. So let's take a look at the tax. 2042 is when the taxes go way up. So we're going to look at 2041. All right, their Social Security is $94,000. They got $31,000 of qualified dividends. Okay, good. Which is basically tax-free. All right, that looks all good. $67,000 of taxable income, but it's not really $67,000 because the bulk of that is qualified dividends and Social Security, which is a taxable. So basically, they pay no tax. Okay, now let's go to 2042 and see why that changes so much. So now we, oh, there we go. So because of the loss of Social Security, it goes from $94,000. The next year when Tim dies at $57,000. So she loses about 40% of her Social Security, but she still's got all those dividends right there. $32,000 of qualified dividends, and now she's a single taxpayer, which means more of that is subject to taxation because she's a single taxpayer. So look at that. That widow's tax trap costs her 100%, or no, 1,000%, right? Increase in taxes right there. Still, though, at the end of the day, that's still preferable to the other scenario, which is IRAs, because when the IRA kicks in, her taxes go through the roof too. because she's a single taxpayer with big required distributions. Anyway, so there's not, I mean, there's stuff you can do about that. You can avoid, you can have no dividend stocks and all that. Look, but at the end of the day, it's still taxed. Those dividends are still taxed much more favorably. I mean, she's got $112,000 in income, dudes, and she's a single taxpayer. All right, actually, she's got more than $100,000. So that's just her AGI. She's got let's see, 32, 112. So she got, where are they getting that 112? I don't know. I have to figure that out. But what I'm trying to show you here is that when she has no IRAs, her tax rates are so much lower. Yes, they're going up here, right? Because we have that 112. Oh, capital gains. That's what's going to be. I bet if we see Schedule D, it's going to see capital gain. Let's take a look. I bet that's what it is. Got to sell something. Yep, right there. Long-term capital gain. So she had to sell some of her portfolio in which to live on, and that's going to be the capital gain. Yep, that's what it was. So we have big capital gains there. But at the end of the day, I wonder if it allows you to do specific identification here. I don't think it does. What you'd want to do is you want to do specific identification. Basically identify the shares that you're going to sell so you don't have to pay those capital gains, if that makes sense. I don't want to get in that here, but the point about this is to show you that $850,000 in a taxable account is better than $1 million in an IRA. Proof is right there, man. Proving wrong. All right, love to hear your comments. We'll see you.